When to buy or sell in Forex trading. Forex trading can be both exciting and daunting, especially when deciding the right moment to buy or sell a currency pair. Success in this market hinges on understanding the tools and strategies available to predict price movements and manage risk effectively. This article explores how to determine when to buy or sell in Forex trading by combining fundamental analysis, technical analysis, market sentiment, and sound risk management practices. Whether you're a beginner or looking to refine your approach, this guide provides a practical framework to help you make informed trading decisions. Understanding the two pillars, fundamental and technical analysis. To decide when to buy or sell, most traders rely on two primary approaches, fundamental analysis and technical analysis. These methods complement each other and, when used together, can provide a clearer picture of market opportunities. Fundamental analysis, the big picture. Fundamental analysis focuses on the economic, political, and social factors that influence a currency's value. Currencies are tied to the health of their respective economies, so understanding these drivers is key to predicting long-term trends. Economic indicators look at data like GDP growth, unemployment rates, inflation, and retail sales. For example, if the Eurozone economy is growing faster than the US economy, the euro may strengthen against the US dollar, USD, suggesting a potential buy for euro to US dollar. Interest rates, central bank policies play a huge role. Higher interest rates attract foreign investment, boosting a currency's value. If the European Central Bank, ECB, is expected to raise rates while the US Federal Reserve holds steady, euro to US dollar could rise. Political events, elections, trade agreements, or geopolitical tensions can impact currency values. Stability often strengthens a currency, while uncertainty can weaken it. Fundamental analysis helps you identify the overall direction a currency pair might take. However, it doesn't pinpoint the exact moment to enter or exit a trade. Market reactions can be unpredictable, as news may already be priced in or overshadowed by other factors. Technical analysis, timing your trades. Technical analysis involves studying price charts and historical patterns to forecast future movements. It's about finding the right entry and exit points within the broader trend identified by fundamentals. Chart patterns, look for trends, uptrends or downtrends, support and resistance levels, or reversal patterns like head and shoulders. For instance, if euro to US dollar is in an uptrend and pulls back to a support level, it might be a good time to buy. Indicators, tools like moving averages, e.g., 50-day or 200-day, relative strength index, RSI, and moving average convergence divergence, MACD, signal overbought or oversold conditions. An RSI below 30 might indicate a buying opportunity if aligned with other factors. Candlestick patterns, bullish patterns, e.g., hammer or engulfing, can confirm entry points, while bearish patterns suggest it's time to sell. Technical analysis excels at timing but can sometimes conflict with fundamentals. For example, a currency might be in a downtrend on the charts despite strong economic data. In such cases, wait for technical confirmation, e.g., a reversal pattern, before acting. Combining fundamental and technical analysis. A winning strategy often blends both approaches. Start with fundamentals, assess the economic outlook for the currencies in a pair. For euro to US dollar, ask: is the Eurozone outperforming the US economically? Are Eurozone interest rates rising relative to the US? Are there upcoming events, e.g., ECB meetings, that could move the market? If the answers point to a stronger euro, you have a bullish bias. Refine with technicals, check the charts for confirmation. Is euro to US dollar in an uptrend on the daily chart? Is the price near a support level or showing a bullish signal, e.g., RSI oversold? If yes, this aligns with your fundamental view, signaling a buy. Resolve conflicts. If fundamentals suggest a rise but the charts show a downtrend, be patient. Wait for a technical reversal or reassess the fundamentals. Perhaps the market is reacting to sentiment or unexpected news. The role of market sentiment. Market sentiment, driven by fear, greed, or collective trader behavior, can override both fundamentals and technicals. For example, strong economic data might not lift a currency if traders are risk-averse due to global uncertainty. Sentiment Tools, the Commitment of Traders (COT) report shows how large traders are positioned, offering clues about potential reversals. Extreme bullishness might signal a sell-off soon. Contrarian thinking, if sentiment is overwhelmingly against the fundamental trend, e.g., everyone is bearish on euro to US dollar despite strong Eurozone data, it could be a buying opportunity. Monitor sentiment to gauge whether the market aligns with or contradicts your analysis. If sentiment opposes your trade, proceed with caution or adjust your risk. Time frames matter. Your trading style influences how you weigh fundamentals and technicals. Day trading, focus on technical analysis and short-term news, e.g., a U.S. jobs report. Quick price movements matter more than long-term trends. Swing trading, balance both, using fundamentals for direction and technicals for entries over days or weeks. Position trading, prioritize fundamentals, holding trades for months based on economic cycles, with technicals fine-tuning entry points. Choose a time frame that suits your goals and adjust your strategy accordingly. Risk management, protecting your capital. No matter how solid your analysis, trades can go wrong. Risk management ensures you stay in the game. Stop-loss orders, set these at key technical levels, e.g., below support, to limit losses. For a euro to US dollar buy, place a stop below the recent low. Position sizing, risk only 1 to 2% of your account per trade. With $10,000, a 1% risk is $100, adjust your position size based on your stop-loss distance. Risk-reward ratio, aim for at least 1 to 2, e.g., risk $50 to gain $100. Set take-profit levels at resistance or based on your ratio. Leverage, Forex offers high leverage, but overuse can amplify losses. Start with low leverage, e.g., 10:1, until you're confident. A practical example, trading euro to US dollar. Let's walk through a hypothetical trade. Fundamentals. Eurozone GDP growth exceeds US growth. ECB hints at a rate hike, the Fed stays neutral. No major political risks loom. Conclusion, bullish on euro to US dollar. Technicals. Daily chart shows an uptrend. Price pulls back to the 50-day moving average with a bullish engulfing candle. RSI dips to 35, near oversold. Conclusion, good entry point to buy. Sentiment. COT report shows traders aren't overly long on euro, room for upside. News sentiment is neutral, not contradicting the trade. Risk management. Buy at 1.1000. Stop loss at 1.0950, below the moving average, risking 50 pips. Take profit at 1.1100, resistance level, gaining 100 pips. Risk reward, 1:2. Execution, place the trade, monitor for surprises, e.g., unexpected US data, and adjust if needed. Additional considerations. Correlations, pairs like euro to US dollar and US dollar to Swiss franc often move inversely. A rising euro to US dollar might confirm a falling US dollar to Swiss franc, reinforcing your trade. News events, major releases, e.g., non-farm payrolls, can spike volatility. Avoid trading during these unless you're prepared for sudden moves. Practice first, use a demo account to test your strategy risk-free. Building your strategy. Here's a step-by-step framework. Analyze fundamentals, identify the trend using economic data and events. Apply technicals, find entry/exit points with charts and indicators. Check sentiment, ensure the market mood supports your view. Set risk parameters, use stop losses, proper sizing, and leverage wisely. Monitor and learn, track trades in a journal to refine your approach. Deciding when to buy or sell in Forex trading isn't about relying on one method, it's about integrating fundamental and technical analysis, understanding sentiment, and managing risk. Start with the bigger economic picture, time your trades with charts, and protect your capital with discipline. Forex trading is complex, but with practice and a structured approach, you can navigate the market confidently. Begin on a demo account, keep learning, and let experience sharpen your skills over time.